What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at the $1.9 trillion stimulus bill that is currently being pushed through Congress. Democrats are getting close to voting on this bill by this Friday, and then the next path for this is to get approved by the Senate, to get passed by the Senate. So today, since it's moving along, we're going to look at what are some of the things that are inside this bill, number one, and number two, what effect is that going to have on things like stocks, gold, bonds, Bitcoin, inflation, and deflation? Ready? Let's dive in. All right, so what is in this bill that they're currently trying to pass right now? Well, the first thing, it is $1.9 trillion. So it's a fairly sizable check that they're planning on writing here. Now, what's included in this? One of the biggest chunks here that they're focusing on is $1,400 in helicopter money, just checks written to people. And these $1,400 checks are going to be per person. That includes children. And for somebody, just an individual filing, their taxes just individually, the income limit is $75,000 to get that. And then married filing jointly, it is $150,000. $1,400 checks per person, including children. Now, another thing that's in this bill is $400 unemployment insurance through the end of August. Now, this is a bump from the current level at $300, so increasing it by $100 per week to $400 through the end of August. Next, we've got about $9 billion reserved in there for COVID testing. That is not just testing, but vaccines and just money sent to local administrations, local governments for, testing, rolling out vaccines, and research as well. Moving on, there's a child tax credit increase. Currently, the child tax credit is $2,000. The bill says that it's going to up that to $3,000 per kid. And for kids under 6 years old, that'd be moved up to $3,600 per kid. And it's also going to be fully refundable. So that means if you don't make enough income to pay taxes that this credit would directly offset, then that comes back to you as a check. So for people making under a certain amount of income with enough children, you're actually receiving a paycheck from the government just for the kids that you have, and that's not just a refund on your tax bills that you already paid through like paycheck withholding. That's just actually money handed to you for having kids. Now, this is temporary, meaning that this tax credit increase in the bill is said that it's temporary. It will expire soon, but the plan is to get that change to become permanent. So temporarily, it's temporary. So we'll see what happens if that sticks and if that becomes permanent afterwards. Next, another thing that's in the bill is a minimum wage increase to $15. It's not immediate though. That'd be rolled out. Minimum wage would be upped for the next 5 years till we get to $15 in 5 years from now. We also have $130 billion reserved for K through 12 schools, and then $350 billion just handed out to local governments, cities, and states who have had budget issues because of COVID. Now, all of this will probably make it through the House by this Friday. It'll probably be voted on and get pushed over to the Senate. And then really, expectations are that most of this will make it through the final bill through the Senate, other than the $15 minimum wage. The expectation is that that is going to be the one sticking point that will probably be difficult to make it through the Senate. Now, ultimately, I wouldn't be surprised if it makes it through as is, because ultimately when you have, maybe it's not now, but maybe it's coming in a couple of months or in a year, but whenever you have inflation start to take off, you start to see inequality spike. You start to see people, the average person, not being able to afford their daily life. The natural government response is to blame corporations, to say it's predatory pricing, and to put in price controls. One of these price controls is a minimum wage. It's centrally planning and setting the price of labor and mandating what free acting individuals and corporations can come to a voluntary agreement on what to pay each other or ask for payment on something like a service or a product or labor. So that's what a minimum wage increase is. And as you have inflation take off, you're more than likely going to see incomes rise as a result. It doesn't happen as fast as the cost of living goes up, but incomes do rise when you have inflation. Most of the time, for the majority of the people, these incomes are going to rise from mandated federally increased minimum wage, and also from stimulus checks, handouts, helicopter money, unemployment insurance, universal basic income, whatever you want to call it. Money just sent to people from the government, and also government setting rules on how much wages are to be paid for at least some specific jobs. Now, if this makes it through, this is going to be a large amount of money just handed out to people. Now, we know that when the government spends a ton of money, when the Federal Reserve creates a ton of reserves, we know that the effects are different depending on where that money ends up, right? The reason why we didn't have a ton of inflation, consumer price inflation, following 2007, 2008, 2009 is because most of the new money that was created went to bailing out the banks, went to bailing out corporations. It went in as kind of like base money in the system. We usually experience globally and historically, you usually experience consumer price inflation when broad money increases. When you hand checks to individuals, that increases the broad money. It increases the amount of money that's in circulation. And so when that happens, that starts to bid up the prices of goods and services. If you have money going to bail out corporations and banks and things like that, financial assets, it bids up the price. There's inflation in assets, and so that makes the ability for that still increases inequality, right? Because the average person can't afford as many assets. It makes it harder to invest and get ahead that way. But you don't have as much consumer price inflation until you start seeing a broad money supply increase. Now, over the last year, we've seen a 25% broad money increase in the United States, which is the biggest since World War II. So it's been absolutely massive. So this will increase that. This will add to that. One of the results of that is obviously going to be the stock market most likely going up at least to front run the amount of money, because we know there's a lot of people that receive these checks that may not need them, or maybe they need them for their groceries, but they can see, hey, if I invest this in the stock market, maybe I make a little bit extra money. I can afford more groceries next week if I invest that. And we know we have a lot of new entrants into the stock market over the last year. I've talked about this specifically in my last video. And because of this, there's a huge likelihood that we see a big boost in stock prices simply from more retail money coming in that came from stimulus checks. What is this going to do to bonds? Well, number one, most of the money coming to pay for this, let's say it's the full 1.9 trillion, the Treasury has been very clear that they're going to start tapping into the money that's in the Treasury general account. Think of this account as the bank account of the Treasury. There's about $1.6 trillion in there right now. This is an account held directly at the Federal Reserve. Prior to COVID, there wasn't anywhere near that amount of money. The government borrowed a ton of money for the first stimulus bill. They didn't spend it all, so there's still 1.6 trillion sitting in there. So the government has been very clear, the Treasury has been very clear, we're going to increase spending, but we're not going to increase our borrowing in order to match that amount of spending. So that means that they have to draw on the reserves that they already have in there. Now that money is out of circulation. That's base money. That's going to pull that money into circulation and send it into the hands of people. That means that's going to cause some inflation. That means bond yields are going to go up. Free market rates go up whenever inflation expectations go up, because if you see inflation is 3 or 4%, you're not going to want to accept 1 or 2% on your debt, because then you're losing money in real terms. So rates will rise in order to compensate for inflation expectations. So this should continue to push rates up until it gets to a breaking point where the government becomes insolvent, the economy becomes insolvent, you start seeing things start to break in the credit markets. At that point, the Federal Reserve will have to step in and start buying more treasuries, buying more bonds, start pushing those rates back down again, lift those bond prices back up. Now, what will that do to gold? That means that in the meantime, we're probably going to still see a little bit of suffering in the price of gold, because the price of gold is very highly correlated to real yields. And if yields are moving up, that's a headwind for gold. It's hard for gold to move up if real yields are moving up. But when real yields start to move down from inflation moving up and then the Fed coming in and buying bonds, pushing real yields down, that's a tailwind for gold. That starts to push the price of gold up. And so that's what effect this might have over the next couple of months on gold. What will it do to Bitcoin? Probably not much. We're probably going to continue to see an institutional adoption as corporations start to see the decline in the purchasing power of the dollar. Might as well buy a little bit of Bitcoin with the corporate treasury just in order to kind of provide an insurance policy against devaluation of those treasury assets. And so we're likely to see a little bit more of that, a little bit more adoption from new companies, more purchases from companies that have already been purchasing. But ultimately, this by itself probably won't have that much of an impact on the price of Bitcoin other than some of the money from the stimulus checks coming in to buy Bitcoin, bidding up the price. I still maintain my price target towards the end of the year at somewhere around $200,000, $250,000, but that's mostly from the stock to flow model, not because of stimulus checks. And finally, what is this going to do to inflation and deflation? I've already touched on this in the video so far, but essentially inflation and deflation is driven by broad money, not base money. And so, I always say that the Federal Reserve printing money causes inflation, and I understand that mechanically that's incorrect. Overall, though, it's still true because it's kind of like saying large food companies are causing the obesity epidemic in America. Well, I know that mechanically that's not true because ultimately you still have individuals and people that are addicted to sugar and eating all this bad food, and it doesn't matter what the food companies do. If individuals and people started just eating healthy food, we wouldn't have the obesity epidemic that we have right now. But we do have a society that's addicted to sugar. So mechanically, while it may not be directly true, you have, let's say, big food companies that are enabling this massive addiction to sugar. In the same way, you have the Federal Reserve printing all of these reserves, bank reserves, enabling the government to spend enormous amounts of money, enabling banks to lend money into existence. You enable this. So yes, in a way, even though it might not be mechanically true because there are multiple steps along the way that each thing has to, trip over in order to cause the inflation in the end, that doesn't mean that overall it's not true, because if the Federal Reserve stopped the printing presses and wouldn't monetize any more debt and stopped buying treasuries, didn't create any more bank reserves, you would have a deflationary collapse. And so just because it's mechanically untrue doesn't mean overall that it doesn't have that same effect. And that's why I mentioned earlier, when the Federal Reserve creates a bunch of new bank reserves and they bail out banks and they give money to the rich, basically, that's not going to directly cause inflation in consumer items right away, because there's not a lot of money going to bid up they're not directly, it's not like burgers at McDonald's are getting bought by all the trillions of dollars that the Federal Reserve printed in 2008, 2009, 2010. But when you start printing trillions of dollars and sending checks to people, that's all that money is going directly to buy things. Very little of it is going into buying assets, because quite frankly, a family of four who gets $4,000 or $5,000 right now, most families have no savings. Most families have a ton of debt, so they're going to use that for the things that they need. That's not going to be life-changing for them if they invest that in an S&P 500 mutual fund, so they're probably not going to do it. Maybe with some of it, but eventually most of that money that's getting sent out in stimulus checks is going to people that actually need it. Therefore, it's going to buy things that the prices will start to go up on, and it's going to leave everybody worse off anyway. And I know the question on your mind is, what about velocity? Because a lot of people say you can print as much money as you want, but if you don't have money velocity, you don't have inflation. And velocity is just the speed at which money circulates through a society. And again, this is one of those things that it's like, well, okay, mechanically, yes, that's true. But the result of increasing the broad money supply, not the base money supply, the broad money supply, is that velocity spikes. And we've been here before. People don't realize that. But in the last 100 years, twice, we've seen money velocity drop to the place exactly where it is right now. And the following years experience the fastest increase in CPI and the most inflation that we've seen in our country in the last 100 years. And so velocity, when it bottoms out here, something happens, typically, money printing, an increase in broad money supply. When velocity bottoms, it rebounds because of an increase in the broad money supply. And so we're seeing that turnover now. So at this point, the game is still going. Increasingly, we're seeing record spending by the government. This is going to continue to cause more inequality, because as you drive new money into a system, what that does is it drives up asset prices, which benefits the rich. It drives up the prices of the cost of goods and services, which hurts the poor a lot more than it hurts the rich, who still have to buy those things, but it just doesn't hurt them as much. And so it increases inequality that destabilizes societies. This isn't good. While the stimulus checks help in the short run, these kinds of extra spending programs by the government are really just a way to take morphine, and they're not dealing with the underlying disease. Now, if you haven't yet and you're looking for a place to invest in gold, silver, Bitcoin to get some of your money out of the system and not have so much exposure to dollars that are losing their purchasing power ever more rapidly as time goes on here and as our government spends more and more of it, then I've got all of my recommended resources linked in the description below. Whether you want to invest in gold or silver physically, hold it in your home, hold it in storage, invest it in an IRA so that it's not taxable. You don't have any taxable consequences from it. I've got all of my recommended resources for those linked in the description below. As always, let me know what you think in the comment section below, and I really appreciate you guys watching. Have a great day.